Hello fellow compounders, welcome back. Today we kick off our special two-part series on the top 10 investment predictions and stock picks or investment picks for 2024. Don't forget to subscribe and turn on notifications to catch every part of this series. Let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. Prediction number 1. The need for diversification in a global uncertainty climate. In 2024, the investment world will be navigating a sea of global uncertainties, from economic volatility to major political events. Diversifying your investment portfolio will be crucial for managing risk from these multifaceted uncertainties. Diversification isn't just about spreading your investments. It's about strategic allocation across different asset classes, sectors, and even geographies. It's a protected shield against unexpected market swings, whether they're caused by economic downturns or geopolitical shifts. A smart way to achieve diversification is through the Vanguard Total World Stock ETF, ticker symbol VT. This ETF provides broad exposure to global stocks, offering a balanced mix of developed and emerging markets and various sectors. As of December 1st, 2023, its price per share was $99.46. It has around $36 billion in assets under management, and its expense ratio is 0.07%. The dividend yield is 1.99%, almost 2%, and over the last 10 years, its annual average return was 7.58%. Investing in VT means tapping into a global portfolio in a single trade. It owns close to 10,000 companies around the world. VT lets you own a piece of companies not just in the United States, but also in Europe, Asia, and emerging markets. This kind of diversification is key in today's interconnected world. It reduces the risk of being tied to the fortunes of a single country's economy and presents opportunities for growth from different regions. This makes VT's broad diversification approach an ideal choice for navigating the unpredictable waters of 2024's global investment landscape. Prediction number 2, the resilience and growth of the stock market. Our second prediction for 2024 is the resilience and potential growth of the stock market. Despite global economic uncertainties, the stock market is expected to remain a vibrant arena for investors. Emphasizing stock investments could be a strategic move, especially if a recession is avoided. Why focus on stocks? Stocks have historically provided substantial growth potential over the long term. They represent ownership in companies poised to benefit from economic growth, technological advancements, and increasing consumer demand. In a landscape without a looming recession, corporate profits are expected to stay strong, making stocks a potentially lucrative investment. To take advantage of this prediction, let's look at Alphabet, ticker GOOGL. Alphabet, the parent of Google, is a giant in the tech sector, known for its consistent innovation and market leadership. Investing in Alphabet means betting on the continued relevance and growth of digital technology and online services. Why choose Alphabet? It's a company at the forefront of multiple growth sectors, from online advertising and cloud computing to emerging technologies like AI and autonomous vehicles. Its diverse business model and robust financials provide a sense of stability amidst market fluctuations. It's trading around $130 per share, and Morningstar estimates its fair value to be around $161. And it gives it a 4-star rating out of 5. While focusing on individual stocks like Alphabet, it's essential to recognize the broader potential of the tech sector. With our lives increasingly intertwined with technology, companies innovating in this space offer exciting growth prospects. However, remember that individual stocks come with higher risk compared to ETFs. So balance and risk management are key. Prediction number 3, sustained higher interest rates. Our third prediction for 2024 revolves around a continued environment of higher interest rates. This shift is expected to influence various sectors from real estate to consumer spending, and it requires a strategic approach to sector-based investing. Different sectors react uniquely to interest rate changes. For instance, financial institutions often benefit from wider interest rate margins, while sectors like real estate might face challenges due to higher mortgage rates. Understanding these dynamics is key. A prime example of a sector benefiting from higher interest rates is the banking sector. Our stock pick is Bank of America, ticker BAC. As interest rates rise, banks like Bank of America can see improved profitability from their lending operations. Bank of America is the main bank that Warren Buffett holds in Berkshire Hathaway's investment portfolio. Morningstar gives it a 4-star rating and a fair value of around $35 per share. Currently, it's trading around $30. BAC pays around 3% dividend yield. While focusing on sectors like banking, it's important to maintain a diversified portfolio. Balancing your investments across different sectors can help offset risk associated with a specific sector's sensitivity to interest rate changes. Prediction number 4. A tightening monetary policy. Our fourth prediction for 2024 is the increasing restrictiveness of the monetary policy globally. Central banks may tighten policies to control inflation and stabilize economies, which could lead to various changes in the investment landscape. A tightening monetary policy means higher interest rates and reduced liquidity in the economy. This can lead to a slower economic growth, making it crucial for investors to seek out sectors and companies that can withstand or even benefit from these conditions. In such an environment, value stocks can be a safe harbor. That's why we're focusing on the iShares Russell 1000 Value ETF, ticker symbol IWD. This ETF offers exposure to large US companies that are considered to be undervalued relative to their fundamentals, like lower price to earnings ratios. Why value stocks? In times of economic tightening, these stocks often outperform their growth counterparts. They're usually more established companies with steady revenue streams, making them less sensitive to economic downturns. The IWD ETF is a great way to gain diversified exposure to this segment of the market. Diversification is still key, even with value investing. The IWD ETF encompasses various sectors like financials, healthcare, and consumer goods, balancing the portfolio against sector-specific risk and offering potential for stable returns. Prediction number 5, transition from zero interest rates. Prediction 5 is about the transition from an era of zero interest rates to a landscape where higher interest rates are the norm. This change particularly affects the bond market, where the strategies need to adapt to the new interest rate reality. In this new rate era, longer duration bonds become increasingly significant. These bonds can offer better yields in a stable or moderately rising rate environment, presenting an opportunity for income-focused investors. A strategic way to tap into this opportunity is through the iShares 20+ year Treasury Bond ETF, ticker symbol TLT. This ETF focuses on long-term US Treasury bonds, which are poised to offer attractive yields in the current rate environment. Investing in long-duration bonds like those in TLT requires careful consideration of interest rate trends and inflation expectations. It's important to balance these bonds with other assets in your portfolio to manage the overall risk. This concludes part 1 of our 2-part series. Stay tuned for part 2, and don't forget to subscribe and share. Remember, always be compounding. Thanks for watching. See you in the next video.